Assalamualaikum and salam sejahtera. For this topic is about financial management for business startup. So what comes in your mind when we talk about financial management? Definitely, you will imagine about numbers and financial reporting, right? So why financial management is very important to entrepreneurs? First, the financial management can demonstrate the company's ability to generate profit and to know what is the company's current financial position. And then with financial management, we can plan and calculate the budget for business expansion and such as acquiring new equipment or planning the new marketing campaign, whether you have plan to increase the inventory levels and the numbers of employees. And also financial management documents in the form of financial statements is a very important document in seeking the financial assistance from the bank and to get capital from the investors. For this topic, I separate into two parts. So this is will be our first part. So at the end of this first part, the student will be able to identify basic documents in the business. And then the second one to explain the importance of financial statement as one of the basic source of information for the business. For this purpose of recording, we will cover the LO1 and the LO2, while the part 2 lecture will be covering the LO3. All right, so in order for us to do the financial management, we need data. And to get the data, we need to keep our business record. So daily transaction of this business must be recorded. For example, sales of goods and items, purchase of goods and items, and payments in terms of payment of for bills, utilities, salary, and etc. So each of the transaction, there must be a document supporting and verify the transaction. For example, for the sales, we're going to have a sales invoice. For the purchase of goods, item or stock, this is the source document, the invoice, and the source document for payment, we have payment slip and voucher. Okay, from this slide, we can see the example for sales purchase invoice, payment voucher. So have a look at the data. We need to have the date, the company's name, the bills, shipped to where, and what is the goods description, how much is the quantity and the price, the total, and how to settle the amount. So in this case, the total payments will be due in 30 days from the date of invoice. This example of purchase order, cash receipt for cash transaction, and petty cash voucher. This is usually issued for daily small expenses in the office. This is the bookkeeping and account, the process of accounting cycle, starting from journal, okay, and report post it to the ledger, and the preparation of trial balance, some year-end adjustment, and finally the preparation of financial statements. So based all this, started with the source document from the previous slide, where we already know about sales invoice, purchase invoice, payment voucher. So based on that, we will start the first recording in the journals
until the preparation of financial statements. So the record keeping process is known as the accounting cycles. It's important to apply the cycle as it will enable comparison with other business. So double entry system will produce financial statements, and the systematic process of double entry system will eventually classify into 5 account categories, which is also known as the elements of financial statement. So what are the 5 elements of financial statement? Asset, liability, equity, revenue, and expenses. What are the assets? Asset is any resources with economic values that business own or control with expectation that it will provide a future benefit. Example given, office equipment, office supplies, inventories, and cash. So all these items is considered as cash as it helps us in generating the revenue for our company. Next is the liability. Liability is legally binding obligation that are payable to another person or entities. Means in simple words is we owe them ataupun kita berhutang. For example, account payables, salary payables, and borrowing. So basically liability is easier to remember is all about the hutang transaction. Next is owner's equity. Owner's equity is defined as the owner's claim to the business assets after all liabilities have been paid. So it also known as net asset. So equity is equals to asset minus all the liability, and whatever remaining here we call it as net asset and also known as the equity. Revenues are the gross increase in equity result from the business activity entered into for the purpose of earning income. So usually there are two main revenues activities: selling merchandise, performing services. Expenses. So expenses are the cost of assets that is consumed or services used in the process of earning revenues. Example for the expenses: cost of ingredient or material use, salary expense, utilities expense, delivery and postage expense, and rent expense. Now, this is the financial statements. There are 3 major statements. First, comprehensive income, or you can also known as statement of profit and loss, balance sheet, or also known as statement of financial position, and lastly is the cash flow statement. So each statement will serve different reasons and serve different needs of information. For example, for statement of profit and loss, it will tell us about our current businesses performance in terms of whether we get the profit or loss. So business performance is measured in terms of profit or loss. The second one, balance sheet and statement or statement of financial position, it will explain the summary of our business financial position, which we will look at how much is our assets, how much is our liability, and our equity. How much is the values of these 3 elements in the uh, financial position. And lastly is the cash flow statement, which show us all the cash inflow and outflows, and is a very useful tool to plan any possible future business activities.
Okay, this is the comprehensive income statement where it is a statement that present business revenues and expenses and resulting a net profit or loss of the business for a specified financial period. Usually will be 1 year of business performance. So we have two elements here. First is revenue and the second one is expenses. So if your revenue is more than expenses, then you will get profit. If your revenue less than the expenses, then the business will incur loss for the period. This slide shows a sample of income statement. So first we start with the name of the company and then the title of the statement and the periods that is covered. For example, in here in this sample is for the year ended 31st December 2021, means that it covers the period from 1st January until 31st December 2021. So this is the period covered for the whole year. Sometimes there are statements that it says for the month, okay, for the month ended, for example, March, March. So it means that it covered from 1st March until 31st March. For that month, this is if it says for the month ended. Now it started with revenues. So this is the element of revenue, and the rest yang tolak-tolak ni means that it's the element of expenses. So revenue in this case is 250,000 minus the cost of goods sold 180,000, and then they have further total expenditure, operation cost, administration cost, marketing cost, and product development cost, and further minus the 58,000. So to get the net in profits, you have to deduct the gross profit with the total expenditure, and at the end you get a net profit of 12,000. The second statement is balance sheet, which currently known as the statement of financial position. So what are the position that we need to know is the asset, liability, and owner's equity at a specific date. So for example, it will say as at 31st December and 2021. At this particular date, which is 31st December 2021, how much is the assets, liability, and equity? So it can give you a business net worth at a specific point of time, and it is present the accounting equation. This is the accounting equation. Assets is equals to total liability plus the owner's equity. Okay, the balance sheet. Let's look at the balance sheet. We have on the left side here is the asset. There are two types of asset. First is the non-current asset, and the second is the current asset. Basically, the assets that we purchase for long-term use, which is more than 1 year, and are not likely to be converted into cash. For example, land, building, investment property, equipment, and office equipment. The other type of assets, current assets, are the cash and other resources that are expected to turn to cash or to be used up within 1 year. For example, if we have stocks and our inventory, we will use up that within 1 year. So it will be categorized under current asset. On the right hand side here, we have the liability and equity. For liability, we have further two types of liability, which is non-current liability and the current liability. So liability is our hutang to the third party. So it's our obligation that we need to settle it, okay, the borrowing ataupun the credit terms. If that obligation, the obligation to settle more than 1 year, so it will categorize under non-current liability. If the amount that due to be paid less than a year, then it will be under current liability. The last one is the owner's equity, is a portion of the value of company's asset that can be claimed by the owners. So whatever the excess of assets over the liability of the business, that is the owner's equity. So total asset tolak total liability, you will get the owner's equity amount. Okay, to see sample of balance sheet, please get one from our textbooks or any sources that available to you. Okay, the third statement is cash flow statement. Statement that shows changes in cash by listing the sources of cash, cash inflows, and the use of cash, cash outflows. So it can give you a sense of whether your business cash flow is increasing or decreasing. All cash transaction, whether cash inflow or cash outflow, must be recorded in this statement. Let's look at example of what constitute cash inflow and what constitute cash outflow. So for cash inflow, that will be from the sales transaction. It only cash sales transaction. And if our debtors pay to us, and if you want to add additional cash capital, the amount of loan injection, or if you receive any cash commission and cash grant. For cash outflow, it will consist of the payment of startup costs to start up the business, purchase of assets by cash, cash purchase of stocks and inventory, payment to creditors or supplier, okay, all cash payment of admin, cash payment of marketing expense, cash payment of operating expenses. So the statement of cash flows forecast format. You can use your cash statement of cash flows to forecast if your business is meeting your expectation. So if the cash inflow is more than cash outflow, then we will call it as we have deficit surplus. If cash inflow is less than cash outflow, then what happens, the effect is cash deficit. The process of preparing cash flow. This is the step. We have 7 steps. First, you have to determine what is your business investment cost. And then the second one, determine your own fund capacity. Estimate the loan disbursement timing. Estimate your sales, cost, payment timing, and put all estimation into cash flow forecast format. This is our cash flow statement in forecast. So we have a 1 year forecast here. So we have the pre-operation cash inflow and cash outflow. Ni yang masa mula-mula nak set up. So when you want to set up your business, first you have to put in the capital, cash capital. So for example, in this slide, we have the owner's fund. And then for the cash outflow, we're going to have several cash payment here, which includes the business registration cost, training, deposit, rental, utilities, telephone, and license. And maybe you have started the promotion, so you have cash payment for marketing. And then you start purchasing the inventory. stocks for to be sold later on. So total cash in minus the total cash out, you will get okay, 20,000 tolak 10,000. So you get a surplus of 9,430 ringgit. So this is the balance that you will carry to the first month. Okay, to the first month here. Let's look at things that happens in the first month. So you have cash sales for 10,000. And then you start buying some assets here. We have computer, fax machine, equipment, furniture, air conditioner, and you do some renovation. So next, you have all these expenses, salary, until miscellaneous, and you do some additional stock, you payment purchase of stocks. So the total cash inflow for the first month is 25,000. The total cash outflow is 30,152. So you have deficit here. So you see there's other column kat sini. Macam mana dapat 5,152, 25,000 minus the 30,152. So you get deficit. But you have, remember you have a balance carried from the previous period. Okay, so you plus 9,430. So you get the balance for the first month is 2,078, which this balance will be carried forward to the second month. And for the second month, there will be no more purchase here. I can see that there's no more purchase of assets. What you will incur here is just normal operation cost. Okay, normal operation cost here. And again, you purchase additional inventory of stocks, okay, for resale. So the process continue until the 12th month, and you can summarize everything. Okay, put it under year one here. Okay, summarize the 1 year cash inflow and cash outflow, and you get how much is the money that you have at the end of period. Okay, that's the end of the part 1. See you in part 2.